Welcome, curious minds, to the deep dive. Today, we're not just dipping our toes. We're plunging headfirst into a topic that, for many, feels like navigating a dense, maybe fog-laden labyrinth:
hmm
tax deductions.
hmm
Specifically, we're going to demystify Schedule A, that often overlooked form that holds the key to, well, potentially significant tax savings for so many of you.
It's absolutely true. What might seem like just bureaucratic fine print is actually, I like to think of it as a treasure map sometimes.
Huh. Yeah.
We'll uncover some, surprising opportunities that could lead directly to more money in your pocket or maybe more accurately, less leaving it come tax season.
Absolutely. Our mission today is pretty crystal clear. We're going to break down Schedule A item by item. We'll have a laser focus on how understanding these intricate details can lead to real, tangible tax savings for you.
hmm
We've really gone through the IRS instructions with a fine-tooth comb to extract every single important nugget of knowledge. The goal is to make you not just informed, but, strategically informed about maximizing your tax benefits.
Sounds good.
Okay, so let's unpack this right from the very beginning. What is Schedule A, Form 1040? At its core, it's the form you use to calculate your itemized deductions. Simple as that, right? It's where you list out specific eligible expenses you've incurred throughout the year that could reduce your taxable income.
That's right. And this brings us straight away to the first absolutely critical decision point for anyone doing their taxes. It's that fundamental choice. Do I take itemized deductions or do I take the standard deduction?
Right.
For the vast, vast majority of people, your federal income tax will be less if you choose whichever of those two amounts is larger. This isn't just a simple calculation. It's really a strategic fork in the road for potential tax savings.
Exactly. So that raises the immediate question for you listening right now. How do you even begin to figure out which one is bigger for you? You can't just guess, can you?
No, definitely not.
That's precisely why understanding the specific categories that make up itemized deductions is so vital. You need to know what expenses even qualify before you can possibly add them up and compare that total to your standard deduction.
Makes sense.
Broadly speaking, the general instructions for Schedule A mention that you can deduct parts of your medical and dental expenses, certain taxes you've paid, interest, charitable contributions, and also, for some, specific casualty and theft losses. We're going to dive deep into each of those categories today, trying to uncover where those smart savings opportunities truly lie.
Okay, but before we get into the nitty-gritty of each category, there's a really crucial general rule that we absolutely must highlight. It's essential for preventing errors and, frankly, ensuring accuracy. It says, don't include on Schedule A items deducted elsewhere,
Right, like where?
such as on Form 1040, Form 1040 SR, or Schedule C, E, or F.
Yeah.
Now, what's kind of fascinating here is that this rule isn't just about preventing you from double dipping, claiming the same expense twice.
Yeah.
It's also about maintaining the integrity of the entire tax system. Think about it. If an expense is directly related to your business or your rental property or maybe your farm, it typically belongs on a different schedule altogether.
Got it. So putting it in the wrong place is a problem.
It can be. Improperly categorizing deductions could lead to your return being flagged. Questions from the IRS. So understanding where each expense truly belongs is not just about maximizing your savings, it's about ensuring compliance with the broader structure of tax forms. It keeps everything neat and tidy, so to speak.
Okay, moving on then. Let's talk about what can be a truly significant, though, often challenging deduction category: medical and dental expenses. This is an area where people often have substantial outlays, but there's a crucial hurdle, a big one, you need to clear before you can deduct a single dollar.
Indeed. This is where the 7.5% adjusted gross income, or AGI, threshold comes into play. You can deduct only the part of your medical and dental expenses that exceeds 7.5% of your AGI.
Okay, and AGI is on line 11 of the 1040.
That's right, Form 1040 or 1040 SR, line 11. So let's put that into practical terms for you. Say your adjusted gross income is $100,000. You can only deduct the medical expenses that are over $7,500.
Wow. Okay, so the first $7,500 basically doesn't count for the deduction.
Exactly. This threshold can make it quite difficult, honestly, for many people to claim this deduction unless they've unfortunately incurred truly significant medical costs during the year. It's a high bar, no doubt. But for those who do clear it, the savings can be substantial.
So given that substantial hurdle, what actually counts towards that 7.5%? Because this is where it gets really interesting, and I think there are some surprising items you might not expect. Let's unpack some of the includable payments, focusing on those less obvious ones maybe, to make sure you're not leaving any money on the table.
Absolutely. So beyond the obvious doctor and hospital bills, You can include insurance premiums for medical and dental care. That's a big one for many people.
Right, premiums you pay yourself.
Yes, premiums you pay. This also extends to premiums for qualified long-term care insurance contracts. However, there are a few important caveats here for maximizing your savings, sort of heads-up items.
Okay.
If you claimed a self-employed health insurance deduction elsewhere on your return, you need to reduce your insurance premiums here by that amount. Can't double dip.
Makes sense.
And you cannot include premiums paid through a pre-tax reduction to your employee compensation. Why? Because those amounts are already excluded from your income in Box 1 of your W-2. The benefit's already been received.
Got it. So if it comes out of my paycheck before taxes, it's not deductible here.
Correct. Also, retired public safety officers can't include premiums paid with a tax-free distribution from their retirement plan.
And on the long-term care insurance, you mentioned those. There's an incredibly specific detail that's often overlooked but could be a significant tax-saving opportunity, especially for those planning for the future, right?
Yes, the amount you can include for these long-term care premiums has age-based limits. It's not unlimited. For instance, if, at the end of 2024, the person for whom the premiums were paid was 71 or older, you could potentially include up to $5,880 for that year. This isn't a blanket deduction for all long-term care. It's very precise, tiered by age, and designed to provide a targeted benefit. So it's definitely worth checking your specific age bracket if you pay these premiums.
Okay. What else counts beyond just doctors and premiums?
Right, so moving beyond traditional medical doctors, the list of deductible practitioners is actually quite broad. It includes acupuncturists, chiropractors, osteopathic doctors, even psychoanalysts.
Psychoanalysts, really?
Yes, but only for medical care specifically, not for general counseling or life coaching, that kind of thing. It has to be medical treatment. Diagnostic tests like full-body scans, pregnancy tests, even a simple blood sugar test kit can be included. This highlights the breadth of what medical care encompasses for tax purposes.
Okay. Now, here's where it gets really interesting for what some might consider like lifestyle expenses. You mentioned programs for specific diseases.
Exactly. Payments for programs aimed at treating specific diseases can count. This includes smoking cessation programs, especially if they involve prescription medicines to alleviate nicotine withdrawal.
Okay.
And here's a big one. A weight loss program can be deductible if it's treatment for a specific disease diagnosed by a doctor. And importantly, this includes obesity.
So if my doctor diagnoses me with obesity and prescribes a weight loss program,
Then the cost of that program could potentially be a deductible medical expense. So if your doctor says lose weight for a diagnosed medical condition, some of those costs might become deductible. It's a great example of a seemingly everyday expense that transforms into a tax-saving opportunity when it's directly tied to a medical necessity.
fascinating. What about aids in travel?
And we also see medical aids like eyeglasses, contact lenses, hearing aids, wheelchairs, and interestingly, even the cost of maintaining a guide dog or other service animal.
Oh.
These are practical items that can definitely add up. Travel costs for medical care are also includable. If you use your own car, you can count 21 cents a mile for 2024, plus any parking fees and tolls you paid.
21 cents a mile. Okay.
And for medical care that requires you to be away from home, lodging expenses are deductible up to $50 a night per person. But there's a big asterisk here. This is only allowed as long as there is absolutely no significant element of personal pleasure, recreation, or vacation involved in the trip.
So no deducting a hotel in Florida just because you saw a specialist there for an hour?
Precisely. The restriction is crucial.
Yeah.
It truly has to be primarily for and essential to medical necessity.
And you mentioned some recent additions, keeping up with the times.
Yeah, as a nod to recent health concerns and modern needs, the IRS instructions specifically highlight the cost of breast pumps and supplies that assist lactation.
Good to know.
And even things like sanitizing wipes and sprays, but only if their primary purpose is preventing the spread of coronavirus. These demonstrate how the definition of medical expense can sort of evolve to reflect contemporary health needs.
Now, this raises an important question for you, the listener. Whose medical expenses can you actually include in your calculation? It's not just your own, right?
That's right. It's broader than many people think. You can include medical and dental bills you paid for yourself and your spouse, naturally.
Okay.
Also for all dependents you claim on your return. But here's a surprising detail that can be a significant tax-saving opportunity for families. You can also include expenses for your child whom you don't claim as a dependent because of the specific rules for divorced or separated parents.
Interesting, even if they live with the other parent.
Yes. under certain conditions related to the divorce decree or separation agreement. Even more broadly, you can include medical expenses for any person you could have claimed as a dependent, except for the fact that that person received $5,050 or more of gross income in 2024, or they filed a joint return, or maybe you or your spouse could be claimed as a dependent on someone else's return.
That's fascinating. So let's connect this to the bigger picture. I think the IRS instructions have a good example, right, about a parent.
Yes, exactly. Consider this scenario. You provided over half of your parent's support, but can't claim your parent as a dependent because they received wages of $5,050 in 2024, even though you can't claim them as a dependent due to that income level.
Okay.
You can still include on line 1 any medical and dental expenses you paid in 2024 for your parent. This really highlights a significant tax-saving opportunity, especially for adult children supporting elderly parents or other family members who might have some income but still rely heavily on you for their medical care.
That's a really valuable point. What about insurance for non-dependents?
Right, another interesting point about insurance premiums, specifically for certain non-dependents. If you have a medical or dental insurance policy that also covers an individual who isn't your dependent. A common example is a non-dependent child under age 27.
Okay.
You generally can't deduct a portion of the premiums for that individual. However, if you already had family coverage when you added this individual to your policy, and crucially, your premiums didn't increase because of adding them.
So the cost stayed the same.
Exactly. Then you can enter the full amount of your medical and dental insurance premiums. It's a nuanced detail, but it could save you money without requiring you to track down separate premium costs if the price didn't change.
Okay, good clarification. Now let's quickly cover amounts you can't include, because these are common pitfalls, right? Things that might seem medical but aren't for tax purposes.
Definitely. You can't deduct the cost of diet food, for example, unless it's specifically part of that weight loss program tied to a doctor-diagnosed disease we just discussed.
Right.
Cosmetic surgery is generally out, unless it's truly necessary to correct a deformity arising from a congenital abnormality, a personal injury resulting from an accident or trauma, or a disfiguring disease. So purely elective cosmetic surgery doesn't count.
Got it. What else?
Other common non-deductible items include things like life insurance premiums or income protection policies. The Medicare tax withheld from your wages and tips is also not deductible here.
Okay.
Also, while it might seem counterintuitive, nursing care for a healthy baby isn't deductible as a medical expense, though other credits, like the Child Independent Care Credit, might apply there.
Right, different part of the tax return.
Of course, illegal operations or drugs are not deductible. Most non-prescription medicines are out things you buy over the counter other than insulin. This includes nicotine gum and certain nicotine patches, unless they're part of that doctor-diagnosed smoking cessation program involving a prescription.
Okay.
Finally, travel your doctor told you to take for just rest or a change is not deductible. Nor are funeral, burial, or cremation costs. Those aren't considered medical expenses.
And one final crucial point on medical expenses, reimbursements and cafeteria plans. How do those affect the calculation?
Super important. If your insurance company paid the provider directly for part of your expenses and you only paid the remainder out of pocket, you only include the amount you actually paid.
Makes sense.
If you received a reimbursement in 2024 for medical or dental expenses you paid in 2024, you must reduce your 2024 expenses by this reimbursement amount. Now, if the reimbursement was for prior year expenses that you already deducted, and that deduction actually reduced your tax in that prior year, then you generally have to include that reimbursement in your income for 2024.
Okay, so it can become taxable income later.
Potentially, yes. And for cafeteria plans or flexible spending accounts, FSAs, you can't deduct amounts already excluded from your income through those plans. So don't include premiums paid by an employer-sponsored health insurance plan unless those premiums were explicitly included in Box 1 of your W-2, meaning they were paid with after-tax dollars. It's all about avoiding double deductions and maintaining accuracy to truly maximize your legitimate savings.
All right, that's a thorough look at medical. Let's shift gears now to the taxes you paid section. This is usually a big one for many taxpayers, especially homeowners, but it comes with a pretty significant federal limitation that caused quite a stir when it was introduced a few years back.
Indeed. What's really central here is the state and local tax, or SALT, deduction limit. Generally, your deduction for all state and local taxes combined, that includes income or sales taxes, plus real estate taxes, plus personal property taxes, is capped.
Capped at what?
It's capped at $10,000 per household, or $5,000 if you're married, filing separately. This limit has had a profound impact, particularly on taxpayers living in high-tax states where state income taxes or local property taxes alone can easily exceed that $10,000 cap.
Right. So even if you paid, say, $15,000 in state income tax and $10,000 in property tax, total $25,000.
You can still only deduct $10,000 on your federal return under this category. Understanding this limit is absolutely critical. It shapes the strategy for many taxpayers.
Before we talk about what is deductible under that cap, let's quickly list some common taxes that are definitely not deductible on Schedule A, just to clear up confusion.
Good idea. Big ones include federal income taxes and most federal excise taxes. Also, Social Security, Medicare, federal unemployment, FUTA, and railroad retirement, RRTA taxes. Those are all out.
Okay.
Customs duties are not deductible here. Federal estate and gift taxes are generally not deductible either, although there's a very specific caveat for line 16 that we'll touch on later if you had income in respect of a decedent.
Got it. What about state and local stuff that's not deductible?
Right. Certain state and local taxes are explicitly excluded. Things like state gasoline tax that's built into the price usually, not deductible here. Car inspection fees, assessments for property improvements that increase value, like putting in new sidewalks.
Ah, but you said repairs are deductible.
Exactly. A charge to repair an existing sidewalk is deductible, but an assessment for a new one generally isn't, that adds to your property's basis instead. Also not deductible. Taxes you paid for someone else, and various license fees like marriage licenses, driver's licenses, dog licenses, things like that. And foreign personal or real property taxes are also generally not deductible on Schedule A.
Okay. Now, you mentioned earlier a unique tax-saving insight involving charitable contributions and state tax credits. Can you elaborate on that? The safe harbor?
Yes, this is an interesting workaround, essentially. There's a safe harbor provision for certain charitable contributions you make where you receive a state or local tax credit in return.
Okay.
The core idea is this. If you made a cash contribution to a qualified charity, and in return, you received a state or local tax credit, which then reduces the amount you can claim as a federal charitable contribution deduction.
Right, because you got something back.
Exactly. You may be able to treat some or all of that disallowed charitable contribution as a payment of state and local taxes instead. This effectively allows you to take a deduction in a different category, potentially getting around the charitable deduction reduction and maybe fitting it under the SALTY cap.
So it shifts the deduction category. Clever.
It is. For example, if you contribute $1,000 to a state scholarship fund, get an $800 state tax credit, your federal charitable deduction might be limited to $200. But under the safe harbor, you might be able to treat that $800, the amount of the credit received, as a state tax payment, potentially deductible up to the $10,000 full cap. It's a way some states and taxpayers navigate the federal limitations.
That's a great example of how different parts of the tax code interact. Now, for many people, this is the crucial choice within the taxes you paid section, line 5. Do you deduct state and local income taxes or state and local general sales taxes? You cannot deduct both. It's strictly in either situation.
Absolutely the critical choice. So let's look at your option. Option 1, state and local income taxes. If you choose this, you'd include things like the state and local income taxes withheld from your salary throughout the year. Check your Form W-2 for that.
Okay.
You can also include state and local income taxes you paid in 2024 for a prior year. For example, if you owed money when you filed your 2023 state return in April 2024, that payment counts for 2024.
Got it. What about estimated payments?
Definitely include any state and local estimated tax payments you made during 2024 for the 2024 tax year. And here's a specific tax-saving detail that many people overlook. Mandatory contributions you made to certain state benefit funds.
Like what?
This includes specific state disability benefit funds, like in California, New Jersey, or New York, or state unemployment funds in places like Alaska, California, New Jersey, Pennsylvania. These are amounts often automatically withheld from your paycheck, and people don't always realize they count as deductible state taxes. It's a great place to look for some extra savings.
Good tip. What not to include for income tax.
Right. You cannot include any state or local income tax refund or credit you expect to receive, or actually did receive in 2024 for a prior year. Those refunds might actually be taxable income to you elsewhere on your return, depending on whether you got a benefit from deducting them in the past.
Okay, so that's option 1, income tax. What's option 2? Sales tax.
Option 2, state and local general sales taxes. If you'll like this instead of income taxes, you'll check the box on line 5A. Now, you have two main methods to figure out the amount. Method A is using your actual expenses.
Meaning keeping every single receipt.
Pretty much, yes. You generally deduct the actual state and local general sales taxes you paid in 2024, but only if the tax rate was the same as the general sales tax rate.
That sounds like a lot of work.
It is, but what's kind of interesting here is that even with this actual expense method, there are specific items where the sales tax is deductible, even if the rate was less than the general sales tax rate.
Oh.
This includes sales taxes on food, clothing, and medical supplies. And even more specifically, sales taxes on motor vehicles. That includes cars, motorcycles, motorhomes, RVs, trucks, vans, even off-road vehicles. That tax is deductible as a general sales tax, even if the tax rate was different from the general rate.
Ah, so car sales tax counts even if it's a special rate?
Yes,
Oh.
but you can only deduct the amount of tax you would have paid at the general sales tax rate on that vehicle, not necessarily the full amount if the rate was higher. And remember, the big drawback here. To use this method, you absolutely must keep your actual receipts showing all the general sales taxes paid. It's a high record-keeping burden, but if you made significant purchases, it could potentially lead to a higher deduction than the tables. Also, quick note, if you received a refund of state or local general sales taxes in 2024 for amounts you paid in 2024, you have to reduce your deduction by that refund amount.
Okay, method A is tough. What's method B, the easier one?
Method B is using the optional sales tax tables. This is definitely the more convenient route for most people. You can find the 2024 optional state sales tax table and the 2024 optional local sales tax tables right in the IRS instructions for Schedule A.
Or online, right? There's a calculator.
Even better, there's a practical tool right on the IRS website. The Sales Tax Deduction Calculator at irs.gov sales tax. It makes it incredibly simple, honestly. It does the math for you.
How does it work conceptually?
The basic concept behind using these tables involves your income level, usually based on your AGI, plus certain non-taxable items, and your family size exemptions. You look up your state, find your income range and family size, and it gives you a base sales tax deduction amount. It also factors in local sales taxes if applicable.
What if you lived in multiple states during the year? That sounds complicated.
It could be, but thankfully, you don't usually have to manually calculate complicated fractions of the year or income proration. The core idea is that you prorate your deduction based on the time spent in each state. But the IRS's online calculator handles all that complex math for you effortlessly. You just tell it where you lived and for how long. It makes optimizing your savings much, much easier.
That's good news. Now, even if I use those convenient tables, is there anything else I can add on top?
Yes, and this is a very significant add-on for many taxpayers. Even if you use the optional sales tax tables, you can add the state and local general sales taxes you actually paid on certain specified big-ticket items.
Like what?
Like motor vehicles, again, cars, motorcycles, RVs, etc. Also, aircraft or boats, but only if the tax rate you paid was the same as the general sales tax rate for those items.
Okay, what about homes?
Crucially, yes. It also includes sales tax paid on a home, including mobile or prefabricated homes, or on substantial additions or major renovations to your home. This is a potential tax-saving gem for homeowners making improvements.
Wow. Any catches?
Yes, a couple of important ones. For the home renovation sales tax, the tax rate paid on the materials must have been the same as the general sales tax rate. And specific conditions apply regarding how the tax was paid. Either your state or locality imposed the tax directly on the sale or improvement, or you purchased the building materials yourself and paid the sales tax directly. Or your contractor was acting as your designated agent in the construction, following your specific directions on construction decisions, which means you're effectively considered to have paid the sales tax on the materials yourself.
Okay, so some specific hoops to jump through for home improvements.
Definitely need to check the details there, but it can lead to large additional deductions on top of the table amount if you qualify.
All right, let's move on to real estate taxes, another component of that SALT deduction limit. This is on line 5B, big one for homeowners.
Yes, a major one. The core information here is that these taxes, state and local real estate taxes, are deductible if they are assessed uniformly at a like rate on all real property throughout the community, and the proceeds are used for general community or governmental purposes. Basically, your standard property taxes.
Okay. What's not included under real estate taxes?
Important exclusions here.
Yeah.
As mentioned, you can't include foreign taxes on real estate. Also, don't include itemized charges for specific services to your property or for you personally, like a monthly charge for trash collection or a flat fee. The city charges for mowing your lawn if it gets too high.
Right.
And this is a common point of confusion we touched on earlier. Charges for improvements that tend to increase the value of your property, like that assessment to build a brand new sidewalk, are generally not deductible as taxes. That cost gets added to the cost value of your property instead.
But repairs are okay.
Exactly. A charge is deductible if it's used only to maintain an existing public facility in service, like a charge specifically to repair an existing sidewalk, including any interest they might charge on that assessment. That can be deducted as a real estate tax.
Okay. For those of us whose mortgage payments include escrow for property taxes, what's the practical tip?
Great question. Remember, you can only include the amount the mortgage company actually paid to the taxing authority during 2024. This might not be the same as the total amount you paid into your escrow account during the year. Check your year-end mortgage statement, Form 1098 sometimes shows this, or contact your lender.
Good point. What if I sold my home?
If you sold your home in 2024, any real estate tax that was charged to the buyer at closing should be shown on your settlement statement, like the HUD-1 or closing disclosure, and potentially in Box 6 of any Form 1099-S you received. This amount is actually considered a refund of real estate taxes to you, the seller, so you have to reduce your real estate tax deduction by that amount.
Ah, okay.
Yep.
Reduces my deduction.
Correct. And here's a critical detail for tax savings, especially if you're thinking about prepaying next year's property taxes near the end of this year. Only taxes paid in 2024 and that were legally assessed prior to 2025 can be deducted on your 2024 tax return.
Assessed. What does that mean exactly?
State or local law determines whether and when a property tax is assessed. Generally, it's the date when the taxpayer becomes legally liable for the tax, even if it's not due until the following year. This means you can't just arbitrarily pay your 2025 property taxes in December 2024 just to get an extra deduction in 2024, unless those 2025 taxes were already officially assessed by the local government before the end of 2024.
Okay, that's a key timing issue. Good to know. What about personal property taxes? That's line 5C.
Right. These are deductible as part of the SALT limit, but only if the taxes were based on value alone, what they call ad valorem, and they must be imposed on a yearly basis.
Value alone. How does that work?
It's a nuanced distinction. For clarity, think about your car registration fee. Often, part of that fee might be based on the car's value, and part might be based on its weight or some other factor. In that case, you can deduct only the portion of the fee that was based purely on the car's value.
So I might need to look closely at my bill.
Exactly. The part based on weight, or a flat registration fee, for example, is generally not deductible as a personal property tax. This means you might need to examine your vehicle registration bill carefully to separate out the value-based amount to maximize your deduction here.
Okay, finally, within the taxes you paid section, there's other taxes on line 6. What goes there?
You enter only one total amount on line 6, but you must list the type and amount of each tax included on the dotted line next to it. This line is typically used for two main things. First, income taxes you pay to a foreign country.
Okay.
And second, a very specific tax called the Generation Skipping Tax, GST, that might be imposed on certain income distributions from trusts.
Pretty niche stuff.
Very niche. But what's important to note here regarding the foreign income taxes, and this offers a potential tax-saving decision point, is that you might actually be better off taking a foreign tax credit instead of a deduction.
Credit versus deduction.
Yes. A credit directly reduces your tax liability dollar for dollar, which is usually more beneficial than a deduction, which only reduces the amount of income subject to tax. You'd need to look at the instructions for Schedule 3, Form 1040, for details on claiming the foreign tax credit instead. It's often the better financial move if you qualify.
All right, that covers taxes. Let's turn our attention now to what can be another very substantial deduction for many homeowners. Interest you paid. This starts on line 8. What's the general rule here?
The general rule of thumb, right off the bat, is that personal interest is generally not deductible.
Meaning?
Meaning interest on your credit card for everyday purchases, or a loan you took out for a new TV, or a personal vacation loan. That kind of interest typically won't give you a tax deduction.
Okay, but there are big exceptions.
That's the crucial distinction. While that general personal interest isn't deductible, there are two significant exceptions relevant to many, many taxpayers. First, qualified home mortgage interests, which we'll dig into now for Schedule A.
Okay.
And second, certain student loan interest, which is also deductible but gets claimed elsewhere, on Schedule 1, Form 1040, not here on Schedule A.
Got it. Student loans are separate.
Right. And what's kind of foundational here is the concept of loan proceeds allocation, or tracing. Think of it like this. If you take out a loan, say a home equity loan, and you use some of that money for qualifying home improvements and another part for, say, a non-deductible purpose like paying off student loans or buying a car.
Okay.
You must trace how that money was used to properly allocate the interest paid. The interest on the portion used for the qualifying home improvements might be deductible home mortgage interest, while the interest on the portion used for the non-qualifying purpose would generally be non-deductible personal interest.
So you have to track where the borrowed money actually went.
Exactly. The use of the funds is key.
Okay, so let's zero in on home mortgage interest then, because this is often the single largest itemized deduction for many homeowners. What exactly is a home mortgage for tax purposes?
It's defined very broadly here. It's basically any loan that is secured by your main home or a second home. It doesn't matter what the lender calls the loan first mortgage, second mortgage, home equity loan, home equity line of credit, HELOC, refinance mortgage if it's secured by the home. It potentially counts.
And what qualifies as a home? Does it have to be a house?
Not necessarily. A home for these purposes must provide basic living accommodations. That means it needs to have sleeping space, a toilet, and cooking facilities. So potentially a house, a condo, a co-op, a mobile home, a houseboat, even a house trailer or RV with these facilities could qualify as your main or second home.
Interesting. Okay, now the crucial part, the limits. This is where it gets complicated, right?
This brings us to the absolutely vital limits on deducting home mortgage interest. Understanding these is key to figuring out your potential savings. There are a few key limits, or tests, you need to be aware of.
Limit number 1.
Limit number 1 relates to the use of the loan proceeds. As we just touched upon, interest is only deductible if the loan proceeds were used to buy, build, or substantially improve the home that is securing the loan. This is what the IRS calls home acquisition debt, or qualifying debt.
Okay, buy, build, or substantially improve. So this is a really important tax saving implication, or maybe lack of saving implication. If I took out a home equity loan or did a cash out refinance and used that money for something else like a vacation, paying off credit cards, buying a car, the interest on that portion of the debt is generally not deductible on Schedule A, right?
That is absolutely correct under current law. This is a common misunderstanding that can lead people to overstate their deductions. The loan proceeds must be traced to buying, building, or substantially improving the home itself for the interest to qualify.
Is there any exception? Old loans?
Yes, there's a grandfathering rule. The only major exception to this specific use limit is for mortgage debt taken out on or before October 13, 1987. For that very old debt, the loan proceeds are generally treated as having been used to buy, build, or substantially improve the home, regardless of their actual use. But for anything newer, the use test applies.
Okay, that's limit 1, use of funds. What's limit 2?
Limit 2 involves debt ceilings based on the date the loan was taken out, specifically related to home acquisition debt, the buy, build, improve kind.
Okay, different limits depending on when I got the mortgage.
Exactly. For qualifying home acquisition debt taken out on or before December 15, 2017, you can generally deduct interest on up to $1 million of that debt, $500,000 if you're married filing separately.
$1 million, okay.
However, for qualifying home acquisition debt taken out after December 15, 2017, the interest is deductible only on up to $750,000 of that debt, $375,000 if married filing separately.
Ah, so the limit decreased for newer loans. What if I have both old and new loans?
Good question. If you have both types of loans, some from before the cutoff date, some after the $750,000 limit for the newer debt, is actually reduced by the amount of your older $1 million limited debt. So the combined limit for all qualifying acquisition debt generally can't exceed $1 million, 500K MFS, for the older debt portion, and the newer debt portion is further capped at 750K, 375K MFS, considering the older debt first. It gets a bit complex if you have multiple loans from different periods.
Okay, so these limits can definitely reduce the deduction for people with very large mortgages or maybe multiple mortgages on a main and second home.
Absolutely.
Yep.
And finally, there's potentially a third limit based on the fair market value FMV of your home. If the total amount of all your mortgages secured by the home is more than the home's fair market value at the time the last mortgage was taken out, your deduction for the interest on the portion exceeding the FMV might be further limited.
Wow. Okay, so use of funds, debt amount date, and fair market value. Lots to consider.
It emphasizes that simply having a mortgage doesn't automatically mean all the interest you pay is deductible. These specific conditions and limits must be met.
So how do I actually report this? Most people get a form, right? Form 1098.
Yes, most people will receive a Form 1098 mortgage interest statement from their lender. The amount of interest reported in Box 1 of that form usually goes directly onto Line 8 of Schedule A.
What if the Form 1098 amount seems wrong, or maybe it doesn't include all the interest I paid that qualifies?
Good point. Sometimes the 1098 might not reflect everything, maybe points paid, or interest calculations based on those limits we just discussed. If the amount of deductible interest you paid is more than what's shown on Form 1098, you can still include the larger deductible amount on line 8A. But you need to explain the difference. If you're filing a paper return, the IRS asks you to attach a statement explaining why the amount is different and write "See attached" next to line 8A. If filing electronically, your software should handle this.
Okay. What if I paid mortgage interest but didn't get a Form 1098? Like maybe I bought a house directly from the seller and I'm paying them. Seller financing.
Exactly. If you paid deductible home mortgage interest to a recipient who didn't provide you with a Form 1098 seller financing,
Yeah.
is the classic example. You report that deductible interest on line 8B instead.
Okay. Line 8B. Any special rules there?
Yes, and this is a key compliance detail, really important. You must write the recipient's name, their identifying number, which is usually their social security number, or if it's a business, their employer identification number, EIN, and their address on the dotted lines provided next to line 8B.
I have to put their SSN on my tax return.
Yes, you do. And you also have a responsibility to let them know your SSN. Failure to show this required information about the recipient on your return or failure to let them know your SSN could result in a $50 penalty for each failure. So while seller financing might seem informal, the IRS reporting requirements are quite strict to prevent abuse.
Good heads up. What if I share a mortgage?
Right. If you paid interest on a mortgage where you're jointly liable, but the Form 1098 was sent to someone else, like a co-owner who isn't your spouse, you'd report your share of the deductible interest on line 8B as well. You should also indicate the name and address of the person who received the Form 1098, showing the interest you paid.
Okay. Now what about points? Those upfront fees paid to the lender at closing, usually a percentage of the loan amount. Where do they go? Line 8C.
Yes, points generally go on line 8C, but the rules for deducting them are specific. The general rule is that points paid only to borrow money, sometimes called loan origination fees or discount points, are potentially deductible. Points paid for other services from the lender, like appraisal fees, inspection fees, title fees, attorney fees, property taxes, those are not deductible as interest points. You have to look at your settlement statement carefully.
And how do I deduct the points I can deduct all at once?
Generally, no. For a loan to buy or improve your main home, you might be able to deduct all the points in the year you paid them if you meet a series of specific tests, like it being an established business practice, points not exceeding the norm, paying them directly, etc. However, for most other situations, including points paid on a second home mortgage or points paid when you refinance an existing mortgage, you generally must deduct the points over the entire life of the loan.
Spread them out. How does that work?
You basically amortize them. You divide the total points paid by the number of payments over the loan's life. For example, 360 payments for a 30-year mortgage, and deduct that small amount each year.
Okay. What about refinancing? You mentioned that.
When it comes to refinancing, the nuance here is significant for potential tax-saving opportunities. As I said, generally points you paid just to refinance an existing mortgage must be deducted over the life of the new loan. This applies even if the new mortgage is secured by your main home.
But is there an exception?
Yes. Here's a crucial tax-saving opportunity. If you used part of the cash proceeds from the refinancing specifically to substantially improve your main home.
Ah, back to the buy, build, improve rule.
Exactly. Then the portion of the points related to that improvement money may be fully deductible in the year you paid them, assuming you meet the other tests for deducting points in the year paid. The rest of the points related to the old loan balance would still likely be deducted over the new loan's life. It's a very specific condition, but it can provide immediate tax relief if you used refi money for improvements.
What if I pay off the mortgage early? What happens to the remaining points I haven't deducted yet?
Good question. If you pay off a mortgage early, for example, you sell the home or refinance with a different lender, you can generally deduct any remaining points that you've been amortizing in the year you pay off that loan.
So I get to catch up on the deduction then.
Exactly. There's an exception, however. If you refinance your mortgage with the same lender who issued the original loan, you generally have to continue deducting any remaining points from the original loan over the term of the new loan. You don't get to deduct them all at once in that specific same lender refi scenario.
Okay, tricky rules for points. Let's quickly move to investment interest, reported on line 9. What is this exactly?
Investment interest is basically interest paid on money you borrowed that is allocable to property held for investment. Think margin interest on a brokerage account used to buy stocks, or maybe interest on a loan where the proceeds were used specifically to buy taxable bonds or land held for appreciation.
Okay. Does it include everything related to investments?
No, importantly, it specifically does not include any interest expense that's tied to passive activities, like certain rental properties, which have their own rules, or interest expense related to producing tax-exempt income, like interest on a loan used to buy municipal bonds. You can't deduct interest used to generate tax-free income.
Is there a special form for this? It sounds complicated.
Normally, figuring out your deductible investment interest requires completing and attaching Form 4952, Investment Interest Expense Deduction. However, there's a key detail, a real tax-saving simplification for many listeners. You don't have to file Form 4952 if all three of the following conditions apply.
Okay, what are the three conditions?
First, your only investment income is from interest and ordinary dividends, minus any qualified dividends taxed at lower rates. Second, you have no other deductible investment expenses, like investment advice fees, which aren't currently deductible anyway for most people. And third, your investment interest expense is less than or equal to your investment income, and you have no disallowed investment interest expense carried over from a prior year.
So if my situation is simple, just some margin interest less than my regular interest dividend income, I can skip Form 4952.
Exactly. If you meet all three conditions, you can deduct the investment interest directly on Schedule A, Line 9, without the extra form. It's designed to streamline the process for smaller, less complex investment interest scenarios. One important caveat, though, Alaska Permanent Fund dividends are explicitly not considered investment income for this purpose.
Got it. Okay, now let's talk about something many people enjoy doing and get a tax benefit for. The art of giving, charitable contributions. This starts on line 11. Big area for deductions.
Absolutely. It's
Yeah.
a popular deduction area, not just for the tax benefit, but because it encourages giving back to causes you care about. The very first step, though, in maximizing this deduction is ensuring the organization you're contributing to is actually qualified by the IRS.
What makes an organization qualified?
Generally, these are organizations operated exclusively for religious, charitable, educational, scientific, or literary purposes, or those that work to prevent cruelty to children or animals. Think churches, synagogues, mosques, most nonprofit schools and hospitals, organizations like the Red Cross, Salvation Army, United Way, etc. Governmental units also count if the contribution is for public purposes.
How can I check if a charity is qualified? Is there a list?
Yes, and this is a great practical tip for our listeners. The IRS has an online search tool called the Tax Exempt Organization Search, or TOS. You can find it easily at irs.gov TOS. You can look up an organization by name, or EIN, to verify if it's eligible to receive tax-deductible contributions. Using this simple tool before you donate can prevent the headache of a disallowed deduction later.
Good resource. So what actually counts as a deductible contribution? Is it just cash?
No, it's broader than just cash. It can be cash, checks, credit card payments. It can also be property things like clothing, furniture, stocks, even cars. And importantly, it can include out-of-pocket expenses you paid while doing volunteer work for these qualified organizations.
Out-of-pocket expenses, like what?
For example, the cost of supplies you bought for a project, or maybe uniforms required for volunteering, if they aren't suitable for everyday wear. And a specific detail here for volunteers who drive their own car. You can deduct the actual cost of gas and oil you use driving to and from the place you volunteer. Or you can use the standard mileage rate for charitable driving.
Is that the same rate as medical travel?
No, it's different and usually lower. For 2024, the standard mileage rate for charity is 14 cents a mile. On top of either the actual costs or the mileage rate, you can always add any parking fees and tolls you paid while volunteering. Just make sure, of course, that you don't deduct any amounts for which the charity reimbursed you.
Okay, 14 cents a mile for charity. Got it. Now, what about situations where I give money but get something back, like a fundraising dinner or a tote bag?
Ah, yes, gifts from which you benefit. This rule is absolutely crucial for calculating your actual tax savings accurately. If you make a contribution to a charity and receive something of benefit in return, like tickets to an event, meals, entertainment, merchandise, you can generally only deduct the amount of your contribution that is more than the value of the benefit you received.
Can you give an example?
Sure. Let's say you paid $100 to a charity for a ticket to a fundraising banquet. The charity tells you that the fair market value of the dinner itself is $40. In this case, you can only deduct $60, $100 payment, $40 value received. This rule prevents you from essentially deducting the cost of something you bought.
So the charity should tell me the value of what I got.
Yes. Qualified charities are generally required to provide a written statement indicating the amount of the contribution that's deductible, especially for these types of quid pro quo contributions over $75. However, there are exceptions for certain low-cost items or membership benefits, for instance. If you make an annual payment of $75 or less and receive benefits like free admission or discounts, you might still be able to deduct the full amount. Or if the benefits received are considered token items, like mugs, keychains, with a very low value relative to the donation.
Okay, now here's where it gets really critical for record keeping, right? Gifts of $250 or more.
Yes, this is a huge rule, a critical one to remember for tax-saving compliance and avoiding disallowed deductions. You can only deduct any single contribution of $250 or more, whether cash or property, if you have a contemporaneous written acknowledgement from the charitable organization.
Contemporaneous, meaning?
Meaning, you must get this acknowledgement from the charity by the date you file your tax return for the year you made the donation, or the due date of that return, including extensions, whichever date comes earlier. You can't wait until you get audited years later to get the letter.
Okay, timely acknowledgement. What does it have to say?
And that acknowledgement has very specific requirements for what it must include to be valid. It needs to state the amount of any cash contributed. For property, it needs a description. But importantly, not the value. The charity doesn't value your donated goods of the property donated.
Okay.
Crucially, it must also state whether the organization did or did not provide you with any goods or services in return for your contribution. If they did provide something, other than those token items or intangible religious benefits, the acknowledgement must include a description and a good faith estimate of the value of those goods or services. If you only received intangible religious benefits, like admission to religious services, the statement just needs to state that.
That sounds pretty specific.
It is. And here's probably the most surprising detail for potential savings, or rather simplified record keeping related to this rule. In figuring whether any single gift is $250 or more, you do not combine separate donations.
What does that mean?
For example, if you gave your church $25 each week through the collection plate for a total of $1,300 over the year, each $25 payment is treated as a separate gift. Since no single payment reaches the $250 threshold, you don't need that formal contemporaneous written acknowledgement for those individual weekly payments, even though the total is high.
So regular small donations don't trigger the $250 rule for each payment.
Correct. This is a common area of confusion for taxpayers, potentially causing them to seek unnecessary acknowledgments for things like weekly offerings. Similarly, contributions made via payroll deduction are also generally treated as separate gifts for each paycheck deduction.
That's really helpful clarification. And what do I do with this written acknowledgement once I have it? Attach it to my return?
No. And this is a very important instruction for you, the listener. Do not attach the contemporaneous written acknowledgement to your tax return. Instead, you must keep it meticulously with your own tax records for that year in case the IRS ever asks for proof.
Keep it, don't attach it. Got it. Now, even if I follow all these rules, are there still limits on how much I can deduct for charitable contributions overall?
Yes, absolutely. Even if you meet all the substantiation requirements, there are still limits on the total amount you can deduct for charitable contributions in any given year. These limits are generally based on a percentage of your adjusted gross income, AGI.
What are the percentages?
It depends on the type of contribution and the type of organization. Typically, cash contributions to most public charities are limited to 60% of your AGI. Contributions of appreciated capital gain property, like stocks held more than a year, to public charities are often limited to 30% of your AGI. Contributions to certain private foundations usually have lower limits, maybe 30% for cash and 20% for capital gain property. There used to be temporary higher limits during the pandemic years, but for 2024, we're generally back to these standard percentages.
Okay, 60% for cash, 30% for property, roughly. What happens if my donations exceed those limits in 1 year? Do I just lose the extra deduction?
No, not necessarily. And this is a significant tax-saving opportunity, especially for those who make large donations. If your eligible contributions exceed these AGI limits in a given year, you don't automatically lose the deduction for the excess amount. The IRS generally allows you to carry over those excess contributions and deduct them in future years.
For how long?
You typically have up to 5 subsequent years to use up those carryover contributions, subject to the AGI limits in those future years, of course. This is a powerful feature that allows for more effective long-term donation planning. You might make a very large gift in 1 year, knowing you can spread the tax benefit over several years if needed. There was a special rule allowing a 100% AGI limit for certain cash contributions in 2020-2021, and carryovers from those years might still be deductible in 2024 subject to the normal limits.
5-year carryover. Good to know. Let's quickly go over some common things people think might be deductible as charity, but actually aren't. Common pitfalls.
Definitely good to cover these. As we discussed earlier regarding state tax credits, certain contributions where you receive a substantial state or local tax credit in return might have their charitable deduction reduced or eliminated, potentially shifting to the SALT deduction category under that safe harbor.
Okay, what else?
You can't deduct amounts paid to a college or university if, in exchange, you receive the right to purchase tickets to an athletic event in their stadium. That's considered a purchase, not a donation.
Right, the seat license kind of thing.
Exactly. Also, travel expenses, including meals and lodging, while you're away from home performing donated services, are not deductible if there was a significant element of personal pleasure, recreation, or vacation involved in the travel. The volunteer work has to be the primary purpose.
Makes sense. Political contributions, club dues.
Political contributions are never deductible as charitable donations. Dues or fees paid to social clubs, lodges, fraternal orders, or similar groups are also generally not deductible. And here's a common one. The cost of raffle tickets, bingo games, or lottery tickets is generally not deductible as a charitable contribution because you're getting a chance to win something.
Can I deduct those as gambling losses, maybe?
Possibly. If you do have gambling winnings to report elsewhere on your return, you might be able to deduct the cost of those losing charity raffle bingo lottery tickets as gambling losses, but only up to the amount of your winnings. That would go on line 16, which we'll get to.
Okay, what about my time? Or donating blood?
You absolutely cannot deduct the value of your time or services you volunteer. Your effort is appreciated, but it's not a deductible contribution. Similarly, the value of blood donated to a blood bank is not deductible.
Good to know. Gifts to individuals, foreign charities.
Gifts made directly to individuals, no matter how needy, are not deductible. Contributions must be to qualified organizations. Gifts to groups operated for personal profit are out. And generally, gifts to most foreign organizations are not deductible, although there are specific exceptions, like for certain Canadian, Mexican, or Israeli charities, if specific treaty conditions are met. Finally, tuition costs paid to a school, even a nonprofit one, are considered a personal expense for education, not a charitable contribution, though you might qualify for education tax credits or deductions elsewhere on your return.
Okay, that covers what doesn't count. Now, back to record keeping for what does. We talked about the $250 acknowledgement rule. What about smaller donations? Line 11 is for cash check gifts. What records do I need?
For any cash, check, or other monetary contribution, like credit card or payroll deduction, regardless of the amount, you absolutely must maintain reliable written records. This means you need either a bank record, like a canceled check image, a bank statement, or a credit card statement showing the charity's name, date, and amount, or a written record from the charity, like a receipt or letter showing their name, the date, and the amount of the contribution.
So even for putting $5 in the collection plate, technically I need some record.
Technically, yes. A notation in your own diary isn't sufficient by itself for cash. You need that bank record or a statement from the charity. Again, you don't attach these records for small amounts to your tax return. You just keep them meticulously for your own records in case of an audit. And remember, that contemporaneous written acknowledgement we discussed for single gifts of $250 or more is in addition to these basic record-keeping rules. You need both if the gift is $250 plus copped.
Okay. Now, line 12 is for gifts other than cash or check, mostly property donations. This seems more complex. How is valuation handled?
It is more complex. The key here is valuation. Generally, if you donate property, you deduct its fair market value at the time you gave it away. Fair market value is basically the price that property would sell for on the open market between a willing buyer and a willing seller, with neither being forced to act and both having reasonable knowledge of the relevant facts.
How do I determine fair market value for, say, used clothing or furniture?
That can be tricky. You might look at what similar items sell for in thrift stores or consignment shops. The IRS emphasizes that for used items like clothing or household items, furniture, electronics, linens, etc., they generally must be in at least good used condition or better to be deductible at all.
Good use condition or better.
Okay.
Is there an exception?
Yes, there's one exception to that condition rule. If it's a single item of clothing or a household item for which you claim a deduction of more than $500, you don't have to meet the good use condition standard if you include a qualified appraisal of the item and attach Form 8283 to your return.
Speaking of Form 8283, when is that required? It sounds important.
It is very important. If the total amount of your deduction for all non-cash property contributions for the year is more than $500, you must complete and attach Form 8283, non-cash charitable contributions, to your return.
Over $500 total non-cash gifts means Form 8283. Got it.
And there are different sections of Form 8283 depending on the type and value of the property. For specific items like motor vehicles, boats, or airplanes valued over $500, you generally also need to attach a copy of the acknowledgement statement you get from the charity. They might use Form 1098-C, contributions of motor vehicles, boats, and airplanes, to your paper return, or provide the info electronically.
What about really valuable property, like art or real estate?
If your total deduction for all donated property, other than publicly traded securities, is over $5,000, you generally have to get a formal qualified appraisal of the donated property and fill out Section B of Form 8283, which the appraiser also has to sign. The rules get progressively stricter as the value increases.
Okay. And just to reinforce, getting Form 8283 filled out or getting an appraisal, that doesn't replace the need for that contemporaneous written acknowledgement for gifts of $250 or more, right?
Absolutely crucial reinforcement. Form 8283 and the contemporaneous written acknowledgement are separate requirements. You might need one, the other, or often both, depending on the gift's value and type. They do not substitute for each other. You need to keep both types of documentation securely in your records. This really highlights that record keeping isn't just a suggestion. It's fundamental for validating your deductions and maximizing your tax savings, particularly when donating property.
Okay. And one last line here in the charity section, line 13, is for carryovers from prior years. Can you just remind us about that?
Right. Line 13 is where you deduct contributions that you couldn't fully use in an earlier year because they exceeded those AGI percentage limits we talked about. As we said, in most cases, you have up to 5 years after the year of the original contribution to use up any carryover amounts that were limited. So if you made a huge donation a few years ago but couldn't deduct it all then, you might still be getting the tax benefit from it on line 13 this year. Check your prior year returns for any carryover amounts.
Excellent. Okay, let's move on now to the less common but potentially very significant deductions for those who unfortunately experience them. Casualty and theft losses. These are reported way down on line 15. What's the main thing to know here?
The main thing, and this is a very strict category now, is that you can only deduct personal casualty and theft losses on Schedule A if those losses are attributable to a federally declared disaster.
Federally declared disaster, so just a regular house fire or car theft doesn't count anymore for personal losses.
Generally, no. For tax years 2018 through 2025, the law was changed so that personal casualty and theft losses are only deductible if they occur in an area officially declared a major disaster area by the president, allowing for federal assistance. This significantly narrows the scope from what many might assume casualty and theft means for tax deductions.
Wow, okay, big change. And even if it is a federally declared disaster, are there still limits?
Yes, absolutely. Even for qualified disaster losses, there are 2 strict monetary limitations you have to overcome. First, the amount of each separate casualty or theft loss event must be reduced by $100.
Yes.
So you ignore the first $100 of loss per event.
Okay, $100 floor per event.
And second, the total amount of all your net casualty and theft losses for the year after applying that $100 reduction per event and after subtracting any insurance reimbursements must exceed 10% of your adjusted gross income, your AGI, from Form 104-104-00 Bond 04 SR, line 11.
Another AGI threshold, 10% this time.
Yes, and that 10% AGI threshold is quite high. It means that even for a federally declared disaster, only truly catastrophic losses relative to your income are likely to result in an actual deduction for most individuals. What's kind of fascinating, or perhaps sobering, is how high that bar is set.
And if you do meet all those criteria, federally declared disaster, over $100 per event, over 10% of AGI total, how do you claim it?
To claim this deduction, you'll need to complete and attach Form 4684, Casualties and Thefts, to your tax return. That form walks you through the calculations, including the limitations.
Okay, Form 4684 for those specific disaster losses. And finally, we come to the very last category on Schedule A, other itemized deductions on line 16. This sounds like a catch-all, but is it?
No, definitely not a catch-all anymore. The instructions are extremely clear here. Only the expenses listed next can be deducted on line 16. The old miscellaneous deductions subject to a 2% AGI floor, like unreimbursed employee expenses, tax prep fees, are gone for now. This line is reserved for a very specific, almost niche list of less common expenses.
Okay. But are there any key details here maybe related to those disaster losses again?
Yes, there are a couple of important details, especially related to disaster losses, that offer potential tax savings even outside of line 16 itself. First, if you have a net qualified disaster loss calculated on Form 4684, line 15, and you are not itemizing your deductions, meaning you're taking the standard deduction instead,
Okay.
you can still claim an increased standard deduction on your Form 1040. You don't report it on Schedule A, but you list the amount of the net qualified disaster loss according to the Form 1040 instructions. This provides a valuable tax-saving path, even for those who typically don't itemize, but were unfortunately affected by a federally declared disaster.
That's great. So disaster victims get a benefit even with the standard deduction. What if I'm itemizing and have a disaster loss?
If you are itemizing, you don't get the increased standard deduction. Instead, you simply list that net qualified disaster loss amount from Form 4684, line 15, directly on Schedule A, line 16, along with any other allowable miscellaneous deductions from the specific list.
Okay. So beyond disaster losses, what other specific, maybe niche deductions can be found hiding on line 16?
The most common one people ask about is probably gambling losses. You can deduct gambling losses on line 16, but only up to the extent of your gambling winnings that you reported elsewhere on your return, usually on Schedule 1, line 8B.
So I can offset winnings, but I can't claim a net gambling loss.
Exactly. You can't deduct more in losses than the amount you won and reported as income. This deduction includes the cost of non-winning bingo, lottery, and raffle tickets, as we mentioned earlier.
Okay. What else is on that short list for line 16?
Other deductions here include casualty and theft losses of income-producing property, like stolen business equipment or damage to a rental property. This is distinct from the personal casualty losses we just discussed and comes from Form 4684, or sometimes Form 4797.
Okay. Business investment property losses.
You can also deduct federal estate tax paid on what's called income in respect of a decedent, IRD. This applies in unique situations where, for example, someone passes away and you inherit income they had earned but hadn't yet received or reported before death, like a final paycheck or certain retirement distributions. You report the IRD as income, but you might get a deduction on line 16 for the portion of the estate tax paid that was attributable to that income. It's highly specialized, so if you think that this applies, definitely look into it further or consult a professional.
Very specific. Anything else?
A few others. A deduction for amortizable bond premium on taxable bonds, an ordinary loss deduction attributable to certain debt instruments, like a loss on a Treasury inflation-protected security or TIPS, a deduction for repayment of amounts under a claim of right if the repayment is over $3,000, certain unrecovered investment in a pension, and impairment-related work expenses of a person with a disability. These are all quite specific, but if they happen to apply to your situation, they can provide meaningful deductions on line 16.
Okay. So after this really deep dive into the intricacies of Schedule A, from medical expenses, taxes, interest, charitable giving, all those surprising nuances in between, what does this all mean for your tax return, for the listener? It all comes down to one final calculation, right? Line 17.
Indeed. After meticulously going through all these categories and adding up all your allowable itemized deductions, you arrive at the total on Schedule A, line 17. And this boils down to that core decision point we mentioned right at the very beginning.
Itemized versus standard.
Exactly. You compare your calculated total itemized deductions from Schedule A, line 17, to the standard deduction amount that applies to your filing status for that year. The key takeaway for maximizing your tax savings is that you generally choose the larger of these two amounts.
Whichever number is bigger gives you the better tax outcome usually.
Right. That larger amount, either your total itemized deductions from Schedule A or your standard deduction, is the amount that ultimately gets transferred to your main Form 1040 or 1040 SR. And that's what directly reduces your adjusted gross income to arrive at your taxable income, impacting how much tax you ultimately owe.
Now, here's a final nuance that many might find surprising. On line 18, right at the bottom of Schedule A, there's a checkbox. It says, if you elect to itemize for state tax or other purposes, even though your itemized deductions on line 17 are less than your standard deduction, check the box on line 18. Why would anyone do that? Why would you choose to itemize federally if it doesn't actually give you the biggest federal tax saving?
That's a really perceptive question, and it points to the complexity of the overall tax picture beyond just the federal return. While itemizing federally might not yield the largest federal tax savings in that specific year for someone in that situation, There are scenarios where choosing to itemize on your federal return might be required or at least beneficial for state tax purposes, or perhaps for other specific financial planning reasons.
How so?
Well, some states, for instance, require you to use the same deduction method, standard or itemized, on your state return as you did on your federal return. Or, even if not required, a state standard deduction might be much lower than the federal one, making itemizing more advantageous at the state level, but you might only be allowed to itemize on the state return if you also itemized federally.
Ah, so state rules might force your hand federally, even if the federal result isn't optimal.
It can happen. So even if your federal itemized deductions are slightly less than your federal standard deduction, checking that box and choosing to itemize federally might unlock a larger overall tax benefit when you factor in your state taxes. Or it might simply be a compliance requirement, depending on your state's specific rules. It's really about looking at the entire financial puzzle, federal and state combined, not just the federal piece in isolation.
That makes sense. It's about the bigger picture. And with that, wow, we've really journeyed through the intricate landscape of Schedule A today. We've uncovered the details of medical expenses, deciphered the taxing truth of deductible taxes, navigated the interesting world of debt-related deductions, explored the art of giving through charitable contributions, and even touched on the unexpected, like those specific casualty and theft losses and other deductions.
We cover a lot of ground.
We did. Our goal wasn't just to list categories from the form, but hopefully to help you, our listener, understand how these rules, often with really surprising specifics and nuances, can directly impact your tax liability and ultimately your financial well-being.
That's absolutely right. Understanding these details isn't just about compliance or, filling out a form correctly, though that's important too. It's truly about empowering yourself to make informed decisions that can lead to real financial advantages. Knowing precisely what's deductible and under what specific conditions and what records you need, that's a critical step in effective financial planning and ensuring you're only paying the tax you truly owe, not a penny more.
So as we wrap up this deep dive, here's a final provocative thought for you to mull over. Given all the surprising deductions, the specific criteria, the record-keeping requirements we've uncovered today, what overlooked receipts, what forgotten details, maybe what misunderstood rules might you have encountered in the past or might you have lying around right now, that with a little attention and understanding could potentially turn into valuable tax savings this year?
And always remember, the tax landscape is, well, it's constantly evolving. Laws change, interpretations shift. So continuous learning and paying attention to these kinds of details are really your best allies in effective financial management year after year.
Well said. Thank you so much for joining us on this deep dive into Schedule A. Until next time.